and join some members in your local ecosystem in cities near you. We have a number of investor meetups that have already happened. I believe about 14 have happened, but we still have about 20 odd happening, and the names on the list, if you see your city name on the list, it means your meetup is either happening this week or upcoming. I know that Abidjan, I know that Dar es Salaam, in fact, Douala is happening this evening, and I know Nairobi tomorrow. So if you have not yet RSVP'd to join an investor meetup happening in your city, please head on over to our website or our LinkedIn page. We have a recap of the investor meetups happening on each week. So Amimo, if you can also share the link for people to RSVP. But yeah, besides hoping to actually see you at the actual investors, at the investor a grand summit in December, just wanted to jump on board and let you know there are in-person gatherings happening. So please make some time once you jump off this call to have a quick drink and to connect in person and to see other investors. Yeah, short and sweet from me. I'll just be on at the end for any announcements in terms of partnerships or tickets. Otherwise, this is not what we're here for. So I'll hand it over to the man himself, Bertil, who will introduce our panel and actually take us to the meatiest parts that you all have arrived for tonight.
Thank you very much, Ayanda. So the main summit in Cape Town is taking place on 28 and 29 November. And it's the 11th edition already. It's pretty crazy. This started off in 2013 as the Africa Angel Investor Summit, together with ABAN, the Africa Business Angel Network. And over the years, it has evolved in the Africa Early Stage Investor Summit. And now we're coming together for the 11th time. So really looking forward to that. And I'm very happy to be hosting you today with an awesome panel to discuss about innovative financing models for early stage ventures as part of this AESIS Academy webinar series. This is the 4th episode, and I'm happy to host you. My name is Bertil van Vught. I'm the Operations Director at VC4A, and VC4A, beyond being one of the organizers of AESIS, is an organization that has been active in the African startup ecosystem for over 15 years, implementing programs and also offering an online infrastructure on vc4a.com to support early stage founders in their journeys and connect them to mentorship, to online learning, to investors, and to support organizations through their programs. I've been with VC for about 10 years, yeah, it's really good to be here and looking forward to this discussion. So on the call today, we have different specialists to talk about the topic. We have Joan Manda, who is the Senior SDG Investment Advisor at UNDP Africa. Of course, I will give them the floor in a sec. We have Nani Burbidge, who is Head of Investments at Untapped Global. We have Francisca Ray, who is Founder and CEO at UNCAP, Unconventional Capital. And we have Azer Songnaba, who is co-founder of Cowris. Before I hand over the floor to them, I would really urge you to use the chat to ask questions. We might not attend to them directly, but at the end, there's a 10-minute Q&A section where we will look at some of the questions. I will also ask the panelists to keep an eye on the chat to be possibly already answering some of the questions during the panel. And also for the panelists, when you hear your fellow panelists say things that interest you or that you want to know more of, please, let's make it an interactive discussion and not just me asking questions. So feel free to jump in at any stage. I would like to give the floor now to the panelists to briefly introduce themselves. Let's hold off on the description of the company and what you do currently, but more focus on your personal story in a few sentences on about how you got here today. So opening up to Joan first. Maybe you want to kick us off?
Thank you so much, Bintel. And it's such a delight to be part of this panel and again engaging on this platform. I'm very much an avid supporter of the Early Stage Impact Summit. We actually had a couple of installations in your sessions last year. So this has become very much a sense of coming home for me. And last year we came in as UNDP talking about impact measurement and management. So it was quite an interesting conversation to have. My name is Joanne Manda, as you've said. I'm with UNDP, not a common partner walking around the halls when it comes to investor meetups. I get that, but very much involved over the past 5-6 years in UNDP, pushing the envelope a little bit and really trying to spearhead UNDP's work on unlocking private capital for the SDGs, for achieving development outcomes. And I sort of fell into this kind of role because of my engagement very much in the climate finance field, where it became very critical early on to think about how to leverage private capital for climate change adaptation and mitigation, and looking at the different financial instruments that made sense within that sphere. It has since, my career has since grown into looking at SDGs more broadly. The COVID crisis for me was a turning point at which we were beginning to get quite a lot of feedback from the market, from private sector players about the importance of sustainability, when everybody realized that, what started off as a health crisis that everybody thought government would manage became very much a socioeconomic crisis that businesses felt in their bottom line. And so it became very clear that public and private partnerships are going to be critical for handling some of the complex crises that the world is facing, and that really need to be taken forward in partnership. So the SDGs became very much at the fore. The ESG conversation really sprang into its own round about the COVID crisis. So a positive, I guess. So I've been very much instrumental in leading the work on investment and unlocking private capital for UNDP, looking at how we use policy as a de-risking measure, but also looking at how financial instruments really need to be shaped in order to deliver finance and capital within the emerging markets that we service. So I'll stop there. Thank you.
Sorry. Yes, thanks, Joanne. Just handing over to Noni.
Hi, thank you so much for having me. It's a pleasure to be here, and I'm really excited about this conversation. Very quickly, my background, I've spent the last 12, 13 years in the financial services ecosystem. I began my career at TBL Mirror Fund, which was an SME private equity firm in 2012. And during my time there, I had an opportunity to found or be the founding executive director of the East Africa Private Equity and Venture Capital Association, or EAVCA for short. And that was an amazing journey. And I led the association for 4 years before moving to a large cap Pan-African private equity firm, and then spending 2 years on the board of EAVCA. I knew at the end of my time at large cap private equity that I really wanted to work in the digital ecosystem and more in venture. I really believed in the ability of tech-enabled businesses or digital solutions to reach those that are underserved and to provide goods and services in a more cost-effective manner and have maybe faster scalability. And so I knew that I wanted to work in the digital ecosystem, and I actually found myself in the Antler program as a startup founder. I ran a startup for 2 years before closing it down, unfortunately, and transitioning into being a VC at a firm called Zephyr. And after 2 years of Zephyr, where a lot of our investments were in fintech, and a lot of those fintech investments were lending businesses, I started to notice that there was a real gap in the market for, again, innovative financing solutions for tech-enabled startups, where maybe equity was not really the right thing that they needed in order to unlock, more growth. And so the opportunity to join Untapped opened up recently, and I joined them in July of this year. So I'm looking forward to being able to tell you a little bit more about Untapped later, but essentially that is my background. Thanks for having me.
Great, thank you. Francisca, you want to go next?
Sure, thanks. Very, very happy to be here. It's fantastic to see so many people interested in innovative finance. I feel like this is, for everyone in innovative finance, this is our time at the moment. So I came to my work at UNCAP through not very straightforward. So I started off as a Greenpeace activist in my youth. So you could think that my path would have been set. But then I actually joined a large German bank to study finance because I felt like activism is very much needed, but money moves the world around. And if you want to change anything, you need to understand money. Back then, naively, I thought the best place to understand money is work at a bank. I learned a lot, had a really good time there. But I always felt that I'm missing this kind of like early activism, sustainability angle. So I moved to a consultancy working on strategy and sustainability, and then to the World Economic Forum, Geneva, working more than any at the intersection again of finance and sustainability on a couple of projects on how to finance the circular economy. But I never felt that I'm where I'm supposed to be. It might sound very vague now, but basically I was working on really good projects. They had a purpose, great people, but somehow something was missing. And I got the opportunity to start my company, UNCAP, together with a friend back then. And we made a very conscious decision to start a company focused on entrepreneurship in Africa. And there's no kind of like heart-sobbing story around it. There's no, we were in safari and we saw a poverty story around it. But basically, we wanted to do something in entrepreneurship. We believe that entrepreneurs can change the world. And there's no continent with greater entrepreneur potential at this moment than Africa. One of the biggest levers we're seeing to kind of like unlock more of that potential is access to finance. And that's basically how we got started with our company. And I'm happy to talk more about it later. And we'll hand over to Azer, I assume.
Azer, yes, please.
Last but not least, of course.
Yeah.
Hi, everyone. Very happy to be here. My name is Azer Songnaba. I am calling you from Ouagadougou, Burkina Faso, country that's not well known in the early stage venture businesses. Yeah, so I'm from here. I am the co-founder and the chief investment officer of Chorus Finance. For my personal background, I actually started my career in banking. So I'm a banker, but a finance professional by training, banker, did 5 years at Goldman Sachs in structured finance, basically securitizing auto loans and auto receivables and selling them to large pension funds and hedge funds. So there I was able to actually gather the essence of what we are currently doing at Chorus that I will tell you more about. And after Goldman, I was hired to join MasterCard in the treasury team, where I was responsible for onboarding fintechs into the MasterCard ecosystem. It was around a time where at MasterCard, they were looking to open up their card rails to fintechs to be able to issue, acquire, and transaction using the MasterCard rail. And my job was to evaluate these companies from a financial standpoint and also from a reputational standpoint to make sure that MasterCard was comfortable associating its brand to these companies. So, yep, and that's where I got acquainted to fintechs, but mainly in North American and America's fintech, so US and Latin America for the most part. But that's where the thesis around fintechs being a force multiplier for promoting financial inclusion actually kind of came about. And that's how about 3 years ago, I co-founded Chorus with some fellow MasterCard alum, where that we kind of joined forces and decided that we could actually use our skill sets to be able to make to solve some financial inclusion problems across the world. And it's as part of the work that I had the opportunity to kind of relocate back on the continent here in Burkina Faso, where we built a team here and also in East Africa, so that we can be closer to our customers. So happy to tell you more about the work that we do at Chorus. Thank you.
Thanks so much, Azer. Yeah, great. So when I was thinking about the topic that we're discussing today, there's you know, the early stage ventures and innovative financing models. I was really thinking about, okay, when we are talking about early stage ventures, that can mean different things to different people. What is early stage? As the Early Stage Investor Summit is a gathering of angels up to VCs and different funders in that range. I would say from pre-seed up to Series A. In different countries, even these funding rounds also differ in terms of sizes, right? In Nigeria, you see a seed round of 5-6 million. While in maybe Burkina Faso, that would be a different ticket size, right? So what are we talking about when we talk about early stage? And I wanted to ask that question to the panelists, and I wanted to also connect that to their investment criteria. So maybe Francisca, you want to kick us off. When you think about, you know, early stage ventures in relation to your work, what do you, where on that spectrum do you find yourself, and how do you cater for that target audience? So what are your criteria? What is basically your investment thesis or investment sweet spot with your work?
Absolutely. No, thanks for that. And I think when we're talking about early stage, it's also not only about what stage and funding size are we talking about, but also what is the nature of the business, which then of course determines what kind of funding they're looking for. So when we started the company, we made a very deliberate decision to focus on early stage SME type businesses. So our focus is not necessarily the high-tech, high-growth companies, but companies that can grow into medium-sized or large companies over time. They are the ones that kind of like very often create basic services, produce basic products that are very much needed, and where we also see the greatest potential for job creation. And for those type of businesses, an equity financing early on is maybe not necessarily the right way to go, because for a variety of reasons. First of all, maybe they don't want to give up ownership. They don't want to be on a path where giving up ownership or selling a business is kind of like the end goal. At the same time, like a very straight debt investment is something that could be quite overburdening for an early stage SME. So we played around with revenue-based financing very early on. And it took us actually quite a while to really figure out, so how do you do that? And when we're thinking revenue-based financing from a Western perspective, very often it's a very narrow focus on businesses in kind of like the e-commerce sector, which is obviously not our target group. So we really had to figure out, so how do you build a model for that type of companies? But also what is the right size of tickets that we want to provide? What age does a company need to be that they're even able to take on a kind of like debt-light instrument? And so what we ended up with developing with like plenty of investments over the last couple of years is a focus on early stage SMEs that are at least 2 years in business. So this is something that we realized like earlier than that, it's really very hard for a business themselves to predict if this is something they could pay back or not. We are targeting a minimum revenue threshold of 80,000 euros ARR. Also, they're tested with various different models on what is kind of like a good minimum threshold, and then also what type of ticket sizes do we want to provide. And so we started off actually quite small. So we started off in the $10,000 to $50,000 range, but realized now that we're increasing the age of the business to like at least 2 years and a minimum ARR, we're now providing investments between $20,000 to $100,000 with a tenure of up to 3 years revenue-based financing. And so just to kind of like close it off on the revenue-based financing angle, we also there played around with different models, revenue-based financing combined with equity, no equity, etc. What we ended up with now is a revenue-based financing loan paid back over 3 years with a monthly payment, where a very small amount is a fixed payment and the large amount of that is a flexible payment depending on your revenues.
Right.
We are focusing on East Africa for now. We've experimented across 7 different countries, actually, from Nigeria to East Africa to a couple of other countries more in Southern Africa. For the next 2 years, we'll focus mostly on Uganda and Kenya, basically just because this is where we have more experience. Our team is also based in Kenya and where we have good partnerships that we want to foster more in the future. Last but not least, we're also using a software that enables us to do these small investments, which usually is very, very hard. So usually transaction costs for small investments are very high. This is why just not a lot of people focus on it. So for us, it was a focus from the get-go when we started the company to build our own tech that enables us to streamline as much of the process that we can to be able to do these small investments.
Right. Yeah. No, there's a reason why the missing middle is still missing.
Yeah.
And I think I've been working in this space for also over 10 years. And yeah, the missing middle discussion is still very alive. And so you're trying to fix that also based on technology, which is really good to hear. From uncapped to untapped, have you guys been ever sort of, mixed up before because of the name?
Yeah, we have, which is more our fault than Untapped fault because they did that first.
Yeah,
But we're actually now, so we start the company as Uncap, and because we've just recently launched our software as a standalone product, we're now branching out our investment arm into unconventional capital to kind of like also just be more distinct. And
right.
yeah.
Yeah. All right. Well, yeah, Noni.
Yeah.
Untapped as asset financing.
Yes.
Can you enlighten us a bit about your model or models and how you work and what your sweet spot is in terms of your investment criteria?
Yeah, sure. So just a very quick background on Untapped Global. Essentially, we offer revenue-based financing, so it's quasi-debt product to tech-enabled SMEs. And the reason I say tech-enabled is because data integration is very crucial for us. This data helps us in 2 ways. But firstly, let me maybe give you an idea of the data we try to collect. So we want to collect data on usage, of the assets, for example, but also of loans. And then we also want to collect data on sort of transactions, i.e. the digital payments. And so we use this during the diligence phase. And then we also use this in terms of ongoing portfolio management. So whilst, we are there to kind of help in terms of closing this SME financing gap, data integration is critical for us as a risk mitigation tool as well. So that is very core to our approach. I think over the years, Untapped has evolved. And so really our bread and butter is very much the smart asset financing product. But we have more recently been supporting fintechs and embedded finance lenders. And so, B2B, say working capital or inventory financing, whether it's for merchants in the market or whether it is, sort of for inventory finance in a different supply chain like pharmaceutical. So we have been expanding outside of the smart asset financing into other digital lenders and embedded finance. And we think that that's a really interesting and growing space for us to kind of support these underserved micro merchants, if you will. In terms of our criteria, I guess the best way to answer that is to tell you a little bit about the strategy of Untapped. And we have 3 phases. So initially we have a pilot phase, and this really allows for a huge degree of diversification, whether it's across geography or even across sector. So whilst I've mentioned fintech and smart asset financing, we've done renewable energy in there, we've done agriculture in there, and of course we've just done B2B lending. And so this pilot phase allows us to kind of test and take in the data, like ingest the data from the underlying operating partner. Depending on how they are collecting and repaying, we use the same model as Francisca at Uncap, i.e. a minimum monthly payment and then a share in the revenue, whether it goes up or down. But depending on how they're paying, the next phase is what we call a sizing, where we really are sizing the operating partner's ability to take on more of this kind of capital and disperse more of it. And so this is, again, larger amounts, and we'd have been with them now for a period of a few months, perhaps. And then finally, once we have consistent data and a good understanding of how they're operating, dispersing and collecting, we'll then do a scale up where we give them a much larger amount. So given those 3 phases, in terms of the criteria, for a pilot phase, we're really looking at obviously revenue generation and the ability to generate revenue and to continue scaling. I would say that maybe a minimum monthly revenue amount would be about $10,000 to $15,000, that is. But we want to see kind of consistent revenue growth. And again, of course, that tech piece is critical. And so I think that's really the main criteria. But one other thing to note is, of course, we need to see positive unit economics. We want to know that you have a very comfortable buffer, and that when we do take a revenue share, it's not going to really affect those underlying unit economics. So alongside this data integration piece, and probably about 10,000 minimum revenue per month, we do need to see positive unit economics. But I'd say that's largely our criteria. We are pretty geographically dispersed. We have a sister company in South Africa. The regulations in South Africa are a little bit different, and so they are slightly siloed. But otherwise, I would say that we are truly Pan-African in that we probably financed a number of businesses all across the continent, from north, for example, Egypt, Morocco, to Kenya, where I sit in the offices here, to West Africa, and of course, Southern Africa, as I mentioned.
Right. Thank you, Nani. Joanne, I will end with you, because you are not pitching a company or a model here. So you can be the independent observer and maybe giving some also thoughts on the different models here and also outside of this group. So going over to Azer, can you introduce your investment criteria and where you operate on the spectrum?
Absolutely. So Chorus is we are a private credit fund. We provide debt capital to enable socially responsible tech companies to scale. And our product is a senior secured loan. Our main product, I should say, is a senior secured loan that we're offering to those companies. And our product is innovative in the sense that these companies are not the type of companies that can actually go, or usually would go to a bank and be able to kind of gather like financing, because a bank will ask you to be profitable for like a couple of years ago, to have hard collateral. Banks tend to like hard collateral that they can touch, right? So basically be buildings or land and things like of that nature. But the companies that we work with are innovative in the sense that they are solving a problem that banks and other traditional players haven't been able to solve. And that's what we are trying to address with our financing solution. So for us, one main criteria that our companies have to have is that they have to be a lender or a provider of financing of some sort, right? And basically trying to touch segments of the populations that are basically being neglected by traditional investors. So that's one thing that's very important for us, right? And tech-enabled for the reason that we are basically need to use technology to be able to verify and understand exactly the risk that we are taking. I mentioned that the bank would like to see a land or a building so they can appraise it and actually give you money against it. But from our standpoint, we do believe that every company has assets that you cannot potentially touch all the time, right? And so for us, it's basically being able to understand the value of the receivables, for example, that these companies have, right? These receivables have value, and if you can value them and monitor them, you can actually like make very good lending decisions off of them. So that's very critical in our underlying work. One of the criteria that
is it comparable to invoice financing, or
I'm sorry?
Is invoice financing very different? Because that's basically just you show me the invoices that are outstanding and I'll get
No. All right. Well, so I think we work with some people who have done trade finance, for example, that was based on receivables. But for us, we're looking at the overall receivable. How is the receivables performing, right? So we work, for example, with mobility players that have leased out motorcycles, right, to many Buddha drivers, right? We want to understand exactly how are those motorcycle performing. So basically, are you getting repaid on time? If you're not being repaid on time, what are basically like the mitigants that you have to make sure that like you're getting payments that will support our facility? And then based on that information, we can actually like size a loan that works great for that fintech. But that and we basically kind of secured with the assets of a fintech. So understanding the performance is actually very important. The other thing that is also very important for us, I think Noni mentioned it, it's positive unit economics, right? A bank will require you to be profitable for 3, 4, 5 years, right? That means a company that's been in existence for a longer period of time, right? But the problems that are being solved right now have been problems that were there for a long time, but no one really has done that, right? So if you look at like the fintech ecosystem, the earliest fintech you can think of were probably around like 10 years ago, right? I think like 10, 15 years ago, if you really want to look large, right? So, but for us, positive unit economics with a path to profitability is one thing that's very important. And that's why our financing is actually allowing these folks to get there, right? Because we will come in and for someone who has done like $500,000, $1 million loan book, right? So basically kind of like proven the business model, we will take them from there all the way up to 10 million, right? So that's basically kind of how we want. And for us to do that, we need to make sure that you have a consistent and repeatable process, right? We want to understand that you can disperse loans and collect them, right? Very important. So what we do, right? So that's why we don't say that, oh, I want you to be around for 2 years, 3 years. It's not a hard number, but like, can you prove to us that you're able to disperse and collect loans, right? And we look at cohort analysis and the like. So that's our main product. So just to kind of wrap up, so our main fund basically has like senior secured debt that goes from 2 million, right, to 10 million with a sweet spot around 5 million. I think you will say, okay, this is not early stage, right? But I think when you look at the when you look at the ecosystem at large, very few where we work in, right, between the $2 to $10 million range, or in our sweet spot is actually like at 5 million. There's some players, but very few players in it, right? Because for anyone who's actually like wants a loan for less than $1 million, equity can be used for that. And I'm very glad, I'm really appreciating the collaboration that we have. On top, for example, we share portfolio companies together. So we have some players that are actually like there. But then, and also you have some players like, for example, the DFIs. So we see a lot of DFIs, large funds that actually want to fund businesses, but they have minimum ticket sizes of 5 or more, right? So then you are stuck in the middle. We talk a lot of fintechs who are, okay, I'm at 1 million. How do I get to 5? Nobody wants to touch that. That's kind of where we come in and play, and we can actually help them scale and get to that level. And also why 2 million? Debt it's kind of a little bit complex product to put together, especially secure debt. So you need a lot of structuring and a lot of monitoring that needs to happen. And the unit economics for typical debt fund actually works when you actually get to a certain size. And that's why the tickets, but our sweet spot is around 5, but we can start with somebody really small with the goal to kind of scale them up to something that's sizable.
Thank you, Azer. So I'm hearing large ticket sizes. I'm hearing 80,000 ARR. I'm hearing 2 years of operations. I'm hearing 10,000 monthly revenue. For Joan, I know you've been also working in the UNDP Innovative Finance Lab that you have. Like, if you put these organizations on the spectrum, you know, what kind of innovative financing models have you seen that also cater for businesses that are maybe a bit earlier than the ones we've been just hearing? Or, you know, what kind of thoughts do you have when it comes to sort of financing businesses that are maybe not yet at that stage that we've just been hearing?
No, thank you very much. And I mean, a lot of the points that my colleagues have raised I can sort of amplify a little bit, because I mean, we're all facing the same kind of challenges and the same kind of issues, particularly if you're looking at the African market, these emerging markets where 80% of the industry is happening within small, tiny SMEs, and as we are pushing forward the sort of tech revolution, really, you still have a lot of enterprises that are still quite small. Small ticket sizes are required, a very fragmented market, a lot of issues around accessing early stage risk capital in particular, finding the kind of business development services that will carry you from your, you know, pre-seed all the way through to Series A. You've seen lots of cases. That's what we're seeing, certainly, lots of cases of enterprises and founders who have great ideas, get into the market, maybe join an incubator or an accelerator program, to get to the end of it, to find that most investors, most financiers, most people who hold the capital, you know, they're situated in a way that their ticket size is too small, or it's not the right kind of investment thesis, or you know, and they fall through the cracks, right? And then you have to get another incubator program, and it's not very easy to kind of grow and build your business. So I was really delighted to hear what Aza is talking about, and also Noni's point around tech-enabled and data, and how we could start to use some of that to reshape the financial instruments that we're deploying and make them a little bit more fit for purpose. I'm in UNDP, actually. We've launched this initiative called the Timbuktu Initiative, which is really meant to be a Pan-African ecosystem building program that's designed to galvanize the startup ecosystem. We are also looking at tech and tech-enabled businesses, mainly because those are easier to take to scale. So I appreciate Francesca's point that actually, if you're looking at sort of job creation and some of the bog standard social services that are still required, you want to look a bit beyond that. But I think it gives you somewhere to start. We are looking at it from early stage, but taking it all the way through, because the idea is to actually have an end-to-end ecosystem support. And I guess that's why UNDP has perhaps the luxury of being able to spread itself across the piece and bring in the right players for the different stage of growth. What we are seeing very much, and I concur with what Francesca mentioned at the beginning there, you know, when you're still in that early stage, debt is probably the better instrument to use, particularly reimbursable grants. We're learning lessons around the fact that, you know, grant disbursements for companies doesn't actually build a company's ability to really go the extra mile and grow. And we're really encouraging those who are working within the business development services ecosystem to think through what it is that we're inculcating. You know, nobody builds a business on free money. I mean, yes, we all start with, you know, friends and fools who will invest in our businesses, but it mustn't become sort of an industry standard. But it's really about trying to train up the founders. In particular, we're learning that a lot of that is critical. And so part of the architecture that we've built within the Timbuktu initiative is looking at how we support founders in terms of the talent and the skills and upskilling that, and making sure that we're empowering young entrepreneurs and women in particular to really have the staying power and the grit to kind of grow with the businesses. I also thought the point around revenue-based financing is a critical one, and I think that's the same thing that Azar and Nana were touching on there, where if you start to really look at sort of cash flow within these businesses, you can actually start to design loan products that make sense, you know, for the sort of ups and downs that the small businesses really have. And so I guess what I'm trying to really outline here is the importance of tailoring the financial instruments to the markets. And we know that the financial architecture is not necessarily fit for purpose. And so we really have to innovate within this space to actually create instruments that make sense for the markets that we are serving, and not sort of believing this missing middle, as you've mentioned earlier. And then I think as these startups really start to grow, then you can start really looking into the equity financing side of things. The Timbuktu initiative has sort of three core components, which is looking at unipods, which is about university innovation pods, where we're trying to catch talent early on and inculcate sort of capacities, skills, capabilities around entrepreneurship, entrepreneurism, digital, that kind of thing, and the tech hubs, where we're really providing long-term patient capital to de-risk enterprises and walk with them through the different rounds of capital raise that you have to go through. So, I mean, your first capital raise might be that really tiny ticket size as a reimbursable grant, but the second one, you start to get into a little bit more sort of commercial terms and so on. And you need 3 or 4 or 5 of these rounds before you even start to bridge that missing middle. So we are seeing it very much as that's how we are wanting to operate. And I just want to add a final point around really looking at the enabling environment. And I think that's where UNDP comes to its strength, because the ability to actually have some negotiation, not only with the financial sector, but with the public sector, around what are the things that we need to be putting in place for de-risking different investments, whether that be policy and regulation, but also financial instruments. And within our fund, we provide some de-risking instruments, like coming alongside another venture capitalist with junior equity or junior debt, or putting alongside a guarantee, or things like that. So those are the sorts of instruments that we're starting to think about deploying. I'll pause there.
Yeah, thank you. Thanks for that. At VC4A, we're also involved in different matching funding programs. I know ABAN has also done that, where investors are also de-risked by sort of putting donor money or program money on the table to match funding, also to try and catalyze investments. But I wanted to ask the panelists also to think a little bit about the future. So when you also think about maybe being able to cater for earlier stage companies, what are some of the things you are talking about internally, or some of the things you're working on for the future to be able to maybe also cater for entrepreneurs that are not at the level yet of the ones that you're catering for today? Is there any thoughts on that?
Yeah, sure. I'm happy to join. So last year, the last 2 years have been very, I think, traumatic for many investors, right? Because I think, especially for debt investor, because most of what we're really looking for is actually have the equity layer to protect basically some of the investment that we're doing, and that has been very scarce, right? In terms of the ecosystem, especially for tech-enabled companies. So equity basically into the ecosystem is something that's very good, very much needed. And I'm glad to start seeing the tide kind of changing, and this is very well positive news for us. And at Chorus, maybe one development that I wanted to mention is that we also realized that we needed to actually kind of have like a sort of also working with company a little bit even earlier than what we are doing right now, right? So we created like a sister fund that's called a graduation fund that essentially is actually like offering unsecured financing to promising companies that we can actually like hopefully graduate into our main fund, right? Because when we look at the pipeline, you have so many companies, but maybe not a lot of them are ready. And can we actually start and help them actually get ready? So this program it's up to $500,000 in ticket size. That we basically do short term with a tenure of up to 6 months. So, but we usually do 3 months, and then we can roll over for another 3 months, and then hopefully at that time the fintech is ready to meet all of our criteria in terms of like data integration, securing the covenants, and not having like some cash runway to be able to actually get it into our main fund. And we think that this is actually going to be very instrumental for us to build the pipeline for our main product, and also to continue supporting companies that are very innovative, but are needing a little bit of push to kind of get to a larger stage.
Thanks. Yeah, Noni, some thoughts on your side?
Yeah, sure. So I think in terms of kind of how we reach the earlier stage, that really would be this kind of pilot product that I had talked about, where our tickets can be anything from, say, 50,000. And the idea behind that, as I mentioned, obviously the diversification, but also we want to start ingesting data, because it's the data that is going to tell us whether they do have the capacity to really, truly grow. Because, of course, a lot of these businesses, if not all of them, the digital lenders, they can only grow as fast as their loan book grows. Now,
Sure.
Incidentally, that also remains true for us as lenders, in this space. And so, yeah, so I think this pilot product of ours, is really catered to that. And the idea behind that is, as these businesses grow their revenues and show that they are capable of deploying the capital we're giving them quickly and collecting it quickly, then we can actually give them the next amount, which is the sizing phase, where we believe that they have grown and shown their ability to scale and that they can actually absorb more of this kind of capital. And then again, we watch to see how they're dispersing and their collection rates. And then thereafter, we know that we can scale with them and give them even larger sums of money. We have discussed having some sort of incubation fund because we believe that the pilot product does have very clear developmental purposes as well. And so we've looked at, various different models. We haven't put anything together at the moment, but we have thought about, how to kind of put this into some level of incubation fund. I think in terms of the future, I really like the fact that revenue-based financing and quasi-debt products or even venture debt are becoming a lot more mainstream. There is probably more FDI that is flowing into lenders like us. And I think that's always good. I think that, as Joanne said, we need to diversify the kind of financial instruments that are available and kind of right-size them to the different opportunities on the ground. Not everything needs, venture capital, i.e. that high growth, high burn kind of capital. And so I really do like that this trend is, for lack of a better word, I don't think it is a trend. I think that, it is innovative financing, but I really do like that more and more kind of global institutions are open and they're willing to hear and they're willing to back. And some of the times they don't quite know how to, but I think conversations like this are obviously really important. Ecosystem builders are also really important, but I think this is definitely a move in the right direction as we see more and more capital flowing to kind of financiers like us that are able to do more innovative products for a very wide variety of different types of digital lenders and embedded finance, providers.
Yeah. Well, thanks. There are a couple of questions from the audience. Maybe our panelists can also answer some of them because they're sort of direct and maybe a bit too niche to also talk about here. I wanted to ask Francisca. So with revenue-based financing, I think you explained that very well in your introduction. You've been sort of testing it out a little bit and you see the model work at this level. But if you would go down much further, then the model also doesn't work anymore, right? And I think that is also the reason why investors are looking at later stage deals, just because the time is spent on due diligence and closing deals just doesn't make sense anymore the lower you go. And so I just wanted to ask you, like based on your experience so far, what do you see as opportunities in revenue-based financing, and maybe also some of the challenges you're facing? Can you talk a little bit about that from your perspective?
Absolutely. And I think it's also something that Nani kind of like explained quite well, that for revenue-based financing, you do need data. And I think you basically have two, generally in the loan space, you have two key issues, right? The first is like, how do you get good data to underwrite a loan or assess an investment? But then also, how do you make sure that someone actually pays back? And if they don't pay back, that this has some level of consequences. And I think because in many of the African countries that infrastructure lacks, that also means that you need to start working with other players in the market to create kind of like that feedback loop of data and behavior. And this is something that I really love to see more of, and I think we will see more of the more players we have in the market that are playing kind of like in different stages of the spectrum, which will then kind of like be a reinforcing mechanism for all the players in the ecosystem, and ideally more players to come into the ecosystem. So I think this is like a crucial thing that all of us need to fix, and ideally together. I think one of the challenges that we still see is that once you do something that is a little bit more innovative than your typical early stage financing structures, raising funding for that is not super easy. Just because the biggest LPs in the market are still the development banks, who are usually can pick from a very large number of funds. And so for them, there is a tendency to prefer plain vanilla funds, basically just purely out of the time it takes to do due diligence and all the different funds. And so I think this is something where we've also experimented quite a lot with. How can we build something that works for us and is tailored to the market and to the companies we want to back, but is still something that could be invested?
How do you get the data from startups at that very early stage? Carlos Albrecht asks, like, how do you get?
I mean, we do a mix of kind of like basically direct input from the companies, but at the same time triangulating that with document parsing. With the help of AI. So we are looking at bank statements, for example, to back up data that you give us, and then see if this is actually a document that has been tampered with. And at the same time, we're starting to also build in more data from other players who have worked with a company that we're interested in before. We've also explored ties into digital lenders, but because most of them go up to probably tickets of up to 10K, like the typical digital lenders that you see in the ecosystem. But there, the overlap from our target group and their target group is usually not too high. So we're basically just like different data sources, self-reported, verified, external data sources, whatever we can get.
Right.
Yeah,
okay.
If I can just comment on some of that. I think
we're getting towards the end.
Good. I'll keep it short.
You want to share some last wise words?
Maybe not so wise, but certainly experiential. Some of the issues around the data issues, utility bills, mobile money, data transactions, that kind of thing really does help. It adds to the richness of the information that you might be able to utilize for due diligence. And we're seeing an increasing number of investors looking into that kind of data and the digital footprint that small enterprises do have. The other point I wanted to raise was around this idea that if you're trying to drill down to the more early stage, really thinking through the link we have between R&D and the market, and at the ideation and incubation stage. I loved what Asa said, which is essentially he's trying to create his own pipeline for his fund. And I think that's one thing that we haven't really seen enough of across the market. When we're creating pipeline, we really need to bring the investor or the off-taking fund up front so that you're already creating a pipeline that's bespoke. Instead of getting to the end of your acceleration program and then, discover that the investment thesis is just a little bit off or the language is off. Again, I can't possibly stop my intervention without mentioning that impact and sustainability is critical. So for us, ESG, impact measurement and management, and in Africa, S is still critical compared to E. So when you're talking to financiers coming from the global North, having to emphasize that fact. Lots of ESG funds being created now, but very much modeled on the EU taxonomy, which doesn't really work for Africa. So we need to really have these strong conversations about what is it that we're really trying to achieve within the context that we're looking at. And the final point is, let's not discount the idea of blending finance and thinking about patient capital that's still required in order to actually service the constituency that we really are thinking about. So I'll pause there. Thank you very much.
Thank you so much, Joanne. I just saw one last question from the audience on sourcing funds. Are you also sourcing funds from local markets, massive amounts of untapped funds sitting in pension funds, cooperatives, societies, etc.? Does any one of you source locally?
Yes, I mean, I think we've had, so of course, we have tried, haven't been able to unlock as of yet.
So we are quite risk averse, right?
Right, exactly right. So especially when we're talking about those pension funds and the like, right now, large private equity funds in Africa are trying to tap into that market, and they actually see them as even being risky to build the roads and buildings, right? Like, so for early stage venture-backed companies, I think it's we're still not there yet, but hopefully we will be able to to touch that capital at some point.
We need some more success stories before they do. Right. Okay, we reached the end of the hour. It always goes so quick, but I think we should stop there. And maybe just give the floor back to June or Ayanda from the AESIS team to close us off. I want to really thank you for your time to be in the panel and to share your stories and experiences with us. Also want to thank the audience for listening in. And I want to hand back the floor to June or to Ayanda. And I hope to see all of you in Cape Town at the Africa Early Stage Investors Summit on 28 and 29 of November. All right. Thank you so much.
Thank you.
Okay, Bertel. Wow, I was still making notes when you were handing over. I was still making actual notes. But rest assured, what a fire panel. Thank you so much to the roundtable for such a scintillating conversation. I got a WhatsApp about 15 minutes ago saying, is this the kind of fire that we can be expecting to see in Cape Town in November? And I was like, absolutely. This is the reason why you buy your ticket now. This is the reason. These are the conversations. We hold them online so that the greater community looking in, those that can't make it to in-person meetups and those that can't make it to the summit, can also get involved and get an insight into what is happening on the continent and who is at play actively on the continent. So this is the purpose of having these conversations. And for that purpose, we also have them recorded. So please rest assured, for those who jumped in late, for those who caught bits and pieces and had to drop off, we will definitely be circulating the recording tomorrow, and we'll putting it up on YouTube for those of you who need to replay and go back and make the notes again about some of the companies and the criteria that had been mentioned here actively. My job is very simple at this point. It's to tell you that, first of all, after this call, when we send you the recording, we'll also be sending you a discount code. For those of you who have still not booked your tickets, this is what this QR code is here for next to me, if you want to scan that. But also it just takes you to our websites to buy the tickets for the 28th and the 29th. For those of you who are still looking for an opportunity to become an active partner, we have a few slots. We have the last few slots. This is literally our last call for partnerships that I can put out. in terms of active activities. So if you're not just wanting to attend AESIS, but really have an opportunity to engage the investor community with, so investor-facing, investor-involving mandate, or opportunities that you would like to spotlight and have a bit well known at the actual summit where you have the right captive audience, please feel free to reach out. Partnerships leads information is on the screen, and Carmela Andrew, but you can also reach out to myself. We have a lot of activities coming up in terms of investor partners. We have opportunities as well as media partners to have opportunities. And then lastly, I wanted to mention delegate packages. So as much as an individual, you will get a discount code. If you are coming as a delegation of 3 or possibly 5 from your network as AngelNet, as angel investors, or as VCs, or just as a group of individuals who are interested in this topic, please do reach out to us. We actually have a good discount that we can enable you, so we don't stretch their pockets too much, so you have enough money left over for investing. But that's about it from us. Thank you very much again to the roundtable, to the panel. This was a very, very, very informative conversation, quite a diverse range. Thank you very much to our conversation captain, Bertel, for taking us through for the last hour. And yeah, from myself and the AESIS team, thank you for joining us this evening, and have a good evening further. Thanks, everyone.
Bye-bye.
Bye.
Bye bye.